My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today our special guest is Jeremy Dyer. He is zooming in from Minnesota where the lights just came back on. At the time we're recording this, there was a massive storm that went through Minnesota, the Dakotas, and tornadoes and all that kind of stuff. So Jeremy, I'm glad you could make it. And if you're not familiar with Jeremy, he's a very, very accomplished real estate investor. He spent a lot of time on the LP side. He started raising capital. He raised a lot of capital on his own from his network in the tune of 50 million. And then most recently, he's come on board as the guy in charge of raising capital for Rise 48. So Jeremy, welcome to the show. Great to have you.
Yeah, Dave, thanks so much for having me. I really appreciate it.
So give us a little snapshot of what real estate investing looks like as of, well, the time this comes out, it's going to be September, October of 2025. What do you do in real estate these days?
Yeah, great question. So I'll kind of explain a little bit about my background and my journey kind of leading up to today. So I was very blessed in the technology sales world to be one of the top performers in that space for about 25 years, which really put me in a position to have discretionary cash on the sidelines to be able to source alternative investments. It was not difficult to max out the 401k. And so I was really looking for, either the next Tesla, Facebook, Amazon stock, or, wanted to cut my teeth in the real estate space. So my wife and I started fixing and flipping houses back in 2012 and kind of the aftermath of the global financial crisis, because quite frankly, Dave, it seemed super sexy on HGTV.
Well, I'm thinking there's anything but passive in that, my friends, which I'm sure you learned very, very quickly.
Yeah, no, you're exactly right. And truth be told, by the year 2015, just 3 years later, we exited the active side of owning, single family homes, primarily because of bandwidth. So in 2015, my wife and I decided to double down on kids. We went from 2 kids to 4 kids. If you're reading between the lines, number 3 and 4 were twins. And I really honestly just didn't have any further bandwidth.
And she probably didn't either.
And she didn't either. Yeah, you're exactly right. So yeah. we really learned about this kind of investing strategy, called syndication investing. And in 2015, I held my breath and I plugged my nose. I found a sponsor that was in the space that I, thought at the time I knew, liked, and trusted. And, I wire transferred my funds in. Fortunately, things went well for that first investment. It went full cycle in 4 years. I doubled my money, and I got bit by the bug at that point, right? So if you fast forward from 2015 now until today, 10 years later, my wife and I are currently active, or passive, I should say, in 40, investment projects as limited partner investors, which span across a number of different, asset classes, whether that be multifamily, assisted living, self-storage, flex office, retail, et cetera. And we've had the opportunity as well to be diversified across investment sponsor, across business plan, across debt structure, all these different ways that we can look to diversify, our holdings across the landscape. And that really put us in a position, Dave, where I really started to learn, kind of the best practices of LP investing and how to properly vet a sponsor, how to properly vet a deal, right? I've had deals that have been home runs, and I've had deals that I've lost 100% of my money on, right? And anywhere in between. So that really allowed me to really learn the business. And then 2 years ago, I started monetizing my own personal network by really sharing what I was going to be doing myself. I would vet a deal, I'd vet an operator, and I'd look to deploy some of my own personal cash into that deal. And I just tell others. It's kind of like when you buy a new car, all of a sudden everybody else is driving that same car, right? And so that's really, what happened for me in my genesis is I just wanted to share, kind of that good news, so to speak, with others in my personal and professional network. And I was really blown away. In 2 years, as a complete side hustle, I was able to raise over $50 million, from my network. And that really put me in a position, Dave, to be able to, really walk away or step away, from my corporate day job. It also increased my stock price, in the real estate syndication space, because every sponsor needs equity to buy deals. And I just happened to have a knack at raising capital from my network, as well as I really understood the business because I was also deploying my own personal cash in deals, and I was able to get, exposed, to the types of sponsors, the types of different asset classes, and really the different types of risk factors, whether that be operational risk or execution risk or, market risk, right?
Mhm.
And so I was put in a position just 9 to 12 months ago, where I was asked to be and head up the capital formation team at Rise 48 Equity, which is a team that dominates really in execution, investor alignment, and growth.
So when you were raising the capital from your own network, how were you typically structuring those raises? Were you a co-GP in deals? Did you set up a fund of fund? How did you organize that as a capital raiser and stay compliant?
Yeah, great question. The first deal that I did, I raised money as a co-GP because I was not even aware of the fund of fund structure, nor was I even aware of the SEC rules around transaction-based compensation. So I quickly pivoted from raising capital as a co-GP to the fund of funds model, primarily for compliance reasons, because I didn't want to just raise capital on one deal. I wanted to raise capital on tens, if not hundreds of deals over time with multiple different sponsors. And I knew that I was not going to be able to prove to an SEC regulator that I was showing material participation in the execution of a business plan if I had raised capital for, dozens of different sponsors across a half a dozen different asset classes in
Mhm.
45 states, right? Just not possible, right? And so I pivoted quickly to the fund of funds model. I set up a flex fund. Most of the deals that I do as single assets, syndications where I'm setting up a separate entity and I'm raising funds, directly through that entity, establishing its own, PPM and operating agreement. And then that fund of funds entity, of course, becomes one single investor into the sponsor's, investment deal. And of course, because we're bringing in a sizable check size into each investment, I also have leverage with the operator, right? And so I traditionally receive a better split, so to speak, on profits as opposed to maybe a fund manager that's bringing in a much smaller check size, if that makes sense.
Oh, absolutely. So it sounds like things went really, really well with that. You quit the W-2 job. Why did you decide to jump on board with another company? And I'm guessing that wouldn't that kind of limit your ability to go out after a whole bunch of different asset classes and sponsors if you're just working with these guys?
Yeah, great question. And again, you remember what I told you before about I got to a point where I had some bandwidth challenges. Okay. The
Mm.
bandwidth challenges that I had in 2015 was truly that I was riding two horses at the same time. I was grinding out the commissions and the bonus checks in the tech sales space while at the same time building up a single family home portfolio on the active real estate side. And I was basically riding two horses at the same time, and I had to set one of them out to pasture. The exact same thing happened, Dave, just about a year ago. I got to the
Mm.
exact same point where Jeremy's grinding out the commission checks in the tech sales space, plus he's building and scaling and growing a very successful in a very short period of time capital raising business that was also consuming more and more of Jeremy's time each week. Plus, Jeremy has 4 children. Three of them are active in hockey. And for those that know the sport of hockey, the state of Minnesota, we skate year round here. And it's every weekend, it's every evening. So again, I was stuck back in that same spot that I was in back in 2015, just within the last year. And I had to make a decision. Do I continue to double down and triple down on raising capital, supporting others to help them replicate the same trajectory or path that I was on, whether they're new capital raisers or they're capital raisers in the space that are capable of raising a few $100,000 per deal, but they want to get to 7 figures, or maybe they're at 7 figures and they want to get, to multiple 7 figures in capital raised. So now I've basically been able to bring both things together, right? So I raise capital, but I also support capital raisers in the space.
Okay, so tell me a little bit about Rise 48. What do you guys do in that company, and how does this kind of integrate that? helping other capital raisers along with that.
Yeah, absolutely. So Rise 48, we've got about 2.4 billion in total transaction volume. We've got 60 deals that we've acquired. We've had 11 deals that have gone full cycle. We operate in markets like Dallas, Fort Worth, Phoenix, Arizona, Charlotte, North Carolina. We transact on an annual basis about 6 to 10 deals per year. We've been continuing to acquire deals in kind of this down market. We really feel like now's a great time to continue to attack the market. Truth be told, it feels a lot like the aftermath of the global financial crisis. There's some fear out there. There's some negative sentiment,
Yeah.
in the industry. But we're continuing to grow by attacking good deals. It's very hard to find good deals, of course. We, underwrite, literally hundreds and hundreds of deals each year to acquire, 6 or 10 of them, right? And truth be told, the deals that we've been acquiring within the last 36 months, in the markets that I described, most of those deals are severely financially distressed from the operations perspective. Most of those deals, the seller is being forced to sell.
Mhm.
Oftentimes, there's not any other buyers. We're the only buyer. And oftentimes, it's the senior lender that's actually reaching out to Rise 48 directly with an off market, transaction opportunity.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So, with these challenging times for a lot of multifamily syndicators and a lot of, LPs that have been burned with other folks and they're kind of gun shy about getting involved in more deals. How are you finding it? What are you guys doing differently for connecting with LPs and raising private capital these days?
Yeah, great point. Obviously, transparency is a huge part of it. I can't tell you how many conversations I've had with existing investors of ours that really appreciate the level and layer of transparency within Rise 48, right? No sponsor in the space today that acquired a deal in 2020, 2020 through 2022 doesn't have some element or layer of distress in their portfolio. Everybody does, right? It just comes down to, how is the sponsor responding? How are they choosing to put the investor first before their own interests? How thick is the ice, under the feet, of the sponsor? Are they capable of supporting that asset, even if investors choose not to participate in maybe a cash call or capital call? But what we found to be the most effective at raising capital is really connecting with investors that are brand new to the space. Okay.
Yeah.
They didn't get started for the first time investing at the peak of the last real estate market. Or
Or before when they got spoiled with all those crazy returns they were getting.
that's right. And I can't tell you how many people that I know in the space, they made 2x their money in an 18-month period on deals that they got into in 2019 that
Yeah.
were disposed of in 2021, right? The
Mhm.
challenge is a lot of them 1031 into another deal at the same
Mhm.
time at the peak of the market, and they're losing money, right?
Yeah.
So everything seems to find its way to kind of regress back towards the mean. But our focus is really to source and identify and find new investors that have previously not been exposed to the space today. The truth is that there's millions of new accredited investors, coming into the fold, on an annual basis. So we're laser focused on educating, that busy professional that's looking for diversification outside of Wall Street into Main Street. When it comes to Main Street, you've got a couple of options, right? You can go start a business, you can go buy into the playbook of a franchise, right? Which is effectively a small business. You can
Yeah.
scratch your entrepreneurial itch, or you can get into real estate and do it either active or passive. So it's really that audience, that we're really trying to target, with our messaging.
Very good. So what do you find most effective for finding these kind of folks these days, Jeremy?
Yeah, it's a great question. Obviously, social media is a great place to go. And I've
Mhm.
been posting on social media consistently for the past 2.5 years. And I'm
On which platform or platforms do you prefer these days?
LinkedIn, Instagram, Facebook primarily.
Yeah.
LinkedIn, of course, being the main place. But truth be told, I tell this to people all the time that I've been posting 5 to 7 times per week on the LinkedIn platform, and I've secured zero net new clients through posting on LinkedIn. The truth is, most people that connect with me because they see something out on LinkedIn, they already know, like, and trust me, meaning they've already been a part of my professional or personal network. Okay. They're people in my professional, space, or their neighbors, or they're people that I worship with at church, right?
Mhm.
These are all people that already have a direct, meaningful relationship with me. And I primarily use those platforms to continue to educate that audience. Yes, of course, I, have an influx of new connections through LinkedIn, but it takes a long time to nurture a cold
Yeah, for sure.
investor to get them to the point of sending in $100,000 wire transfer.
Yes, it's not as quick as some of the gurus make it sound like it is. Yeah, well, that's very, very interesting, Jeremy. Thanks for explaining a little bit about your background and what you guys are up to and why you've made that transition. Makes a ton of sense. I like a lot about what you've said about what you're doing with investors and the whole transparency and just kind of showing them the good, the bad, the ugly of investing, and smart idea going after, fresh investors, so to speak, people that haven't been through the churn and burn of the last few years of multifamily. Because you're right. I mean, everybody thinks, well, nobody's investing anymore. That's not true. It's just you have to go after to fresh fields, so to speak, fresh people that, perhaps they've invested in other things, stocks, bonds, crypto, what have you, but they haven't heard about or they haven't invested in multifamily. Plus, I think the other thing you're saying is you're not just in multifamily. You guys invest in a variety of different asset classes, correct?
Yeah, I do it as an individual LP investor within the
Mhm.
Rise 48, family, so to speak. Our investment buy box is very boring. Okay. It's a very non-sexy business. We are laser focused on really properties that were built in the 1980s, 1990s. These are B-class neighborhoods. It's your traditional workforce housing demographic. And the majority, if not all of the interior units are classic. Maybe the majority or all of the interior units don't have washer and dryers, right? And so really our kind of investment buy box is really acquiring assets at a good basis with a value add or a forced NOI growth,
Mhm.
type of strategy in the markets of Phoenix, Dallas, and Charlotte.
Boring's good. Boring is very, very good. So, Jeremy, if people are watching this, they want to connect with you and find out more about what you guys are up to, where should they go?
Yeah, thanks for asking. I would recommend that you just head over to LinkedIn. You can find me there. I'm relatively active on that platform. You can search for me there under Jeremy Dyer. That's Dyer.
Perfect, Jeremy. Well, it's been a lot of fun. Thanks very much for being on the show.
Absolutely, Dave, and thanks for having me.
Everybody, take care. We'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.